Hello students. Now let's practice how to calculate the free cash flows generated by a company of the year. We have an example of the Quick Burgers income statement 2016 and Quick Burgers balance sheet 2016 and 15 in millions. So it is very important uh, when we calculate the value of a corporations. All the future cash flows discounted by the WACC, and then we uh, make this present value of the free cash flows. That is the intrinsic value, right? So how to get this free cash flows? We also need the additional information, 2016 capital expenditures and the tax rate 35% and $3 million. Okay, $3 billion, sorry, because dimension is in million. Now we have this equation that we already discussed. Free cash flows, the cash available for distribution to investors, both debtors and equity holders, after firm pays for new investment or additions to working capital, because that is cash out. So net income plus interest, add back interest and add back depreciation minus changes in net operating working capital. If the working capital increased, then minus, and the capital expenditures is cash out. So we will consider all the cash inflow or outflow from the net income reconciliation. Free cash flows by debt and equity finance as it is in 2016. Now let's collect all this information starting from net income. Okay, net income 5,251, and we need to add back interest. Interest now minus 517. So we will add back this 517 from net income. Okay, we'll reverse from net income backward to the top, and then add back depreciation. Because depreciation was not actual the cash outlay, cash out. We just assume that our asset value is decreased by this depreciation, but it's not actual cash out. When the company purchased the asset, the capital expenditures, it's all like cash out, but we allocate this cost of this the PP&E or intangible asset throughout the useful life of this tangible or intangible asset. That is the depreciation and amortization, which is not cash outlay. So we should add back this 1,400 too. And change in net working capital. Okay, change in net working capital. What is the working capital again? The current asset minus current liability. Current asset minus current liability is net working capital. The net working capital is now change in net working capital is increase or decrease of between 2 years. So let's collect this current asset. Current asset in 2000. Okay, there we go. And current asset also we collect the same way. So we got it. And then current liability, I want to just put the current liability, then minus current liability. Okay. Then net working capital is just the sum of these two. Okay. Now, as you can see that the company, the Quick Burger, has increased the working capital from 894 to 1519. They increased. The current asset is comprised of the cash, receivable, inventory. If the company increase inventory, increase accounts receivable, increase the cashes, that means that the cash now cash, right? Because this is cash down. Why cash down again? Inventory purchased, that means that cash out, but this income, net income, doesn't include this transaction. What about receivable? The company increased the revenue on credit transaction or credit sales, but they didn't receive the cash. They don't receive the cash, but they increase the sales. That increase the net income. That's why it is cash. You should cash down. So current asset increase. That means that cash down, right? And the current liability increase means that okay, the company doesn't have to pay cash, but they recognize expense. So we have to increase the cash amount again. Okay, so all the accruals, accounts payable, if the company increased the liability between 2 years, that is that the company increased cash. Okay, we've learned this concept in the cash flow statement on the financial accounting class. So net working capital is calculated the current asset minus current liability. So the current net working capital has been increased. That means that current asset working capital has been increased. That means that the company now increased. The company now use cash more. So 629 should be negative. Capital expenditure. How much is the capital expenditure? There you go, 3,049. Even though the company purchased some PP&E or intangible asset, that is the cash out when the company purchased, but it doesn't show any cash out on the income statement. That's why we have to recognize these capital expenditures by reconciling this net income, right? So 3,049. So the free cash flow is now we sum those up. So 3,496 is free cash flows of the year. Now let's calculate what if the company's free cash flows is generated from all equity finance. If it was all equity finance, then let's change this number because we want to know the interest tax shield, the debt financing effect. So let's just start from the net income again, 5,251, and then add back interest. Do we have interest? No, it's 0. Why 0? Because we assume that the company doesn't have any the debt liability, debt financing, because we assume that it is all equity financing. So there's no interest. And then add back depreciation. Again, add back depreciation. Here we go, 14.2. And then change in net operating working capital. Again, I want to use the same information as we gathered in the previous case. And then let's just sum up. Okay, now, just give me a second. Oh, net income, I'm sorry. Net income should not this, I'm sorry. Because net income is not the same as this, because this 5,251 is calculated based on the equity and the debt, both of financing, right? So we need to calculate the net income. How? Before interest, we started from 8,596 before interest, and then we have to pay tax. 1 minus tax rate, 35%. So after tax, then we got 5,581. So we have a new net income. Assuming that it was all equity financing. So the free cash flow based on this all equity financed is 3,350. Then what is the tax shield? Tax shield means tax benefit by borrowing debt so that we can reduce tax payment. Why? Because this interest expense reduced earnings before tax amount. If the company doesn't borrow this debt, That means that there is no interest expense. That means that this EBIT is equal to the earnings before tax. So 8,596, which is the same as this EBIT, is the income before tax. So the company should have paid more taxes, right? So case one, tax by all equity financing is all equity financing. Tax by all equity financing. How do you get it? Tax by all equity financing. How do you calculate it? Right, here we go. From this, right, times 35%, because it is the same as the earnings before tax. So 3009 is tax amount. Then what is the tax by both equity and debt financing? Okay, there you go. We already got it. Here, tax amount 2828. So the difference between two is additional tax amount if the company only use this equity financing in full. So 181. We can also calculate this 181 more tax amount by just subtracting between these two. 181, which is the same. Or interest times tax rate. Interest times tax rate. How do you get it? Interest times tax rate. Okay, I want to just put. Okay, by doing so, the interest amount times tax by this amount, the company would decrease the tax payment. Why? Because this tax interest amount 517 decreases the earnings before tax from this EBIT. Okay, so that is the addition. That is the tax shield, interest tax shield. Why it is important? Why it is important? Based on the different capital structuring, the company can reduce the cash out, right? That's why one of the reasons the company borrow the debt as well. Not 100% equity financing, but both debt and equity financing. Okay, this is all the exercise for the free cash flow calculation procedure. Okay, see you in the next video clip. Bye-bye.